Talking Point. I'm your host, Neeraj Shah. And the Talking Point today are the views of Aditya Suresh of Macquarie. He needs no introduction. He's the strategy team out there. And they've come out. I mean, it'll be lovely to understand his thought process, because when I went through a slew of notes that they've recently come out with, there are a bunch of indications out there which could uh, both prove or both point towards there being green shoots and the same time there being headwinds. My questions to Aditya would be, where is it, or on which side of the table is he sitting on currently, and what is it that he's advising the clients at Macquarie? Aditya, great having you. Thanks for joining in. Hope all is well.
Neeraj, thank you for having me on the show, and it's always a pleasure. So, as you had framed it about green shoots and kind of fault lines, I think the key piece would be the following, right? So, when you think about the broader kind of setup, which is about India's valuation premium, there is no denying that we are at extreme levels, right? So today we're about +3 standard deviations compared to whether it be emerging markets of the world. So that valuation backdrop is clearly full and stretched, right? But I think one of the key shifts, if I may, Neeraj, is that same time, same valuation premium, say today versus say 6 or 9 months back. One of the key differences are the following, right? So like 6 9 months back, our key kind of thoughts were around, like earnings risk on the downside, particularly the margin kind of cuts which we see, whether it be across consumer and IT. We're concerned about oil prices. We're concerned about the impact on the rupee, right? We're concerned about the fact that broadly, we're probably going to see some emerging market fund outflows, and then India being kind of impacted by that. So quite a few of those were palpable risks, right? Higher cost capital in the mix as well. But if you kind of think about the setup here today, not that we're saying that we are outright bullish, if I may, at these levels, right? But in terms of are we kind of positioned more for a correction? Not really, right? To the extent that despite the valuation premium being full, I think it's interesting just to note that point one, the earnings risk which we had spoken about, a lot of that is in the base now, right? Whether it be consumer or IT, you've seen the June quarter that the cuts have kind of come through on margin estimates. So that's interesting. Financials, you're actually seeing a bit of upgrades kind of come through as well. So on the earnings side, we're feeling far better on what's in the base, if I may, right? We've had kind of higher cost of capital. Inflation is kind of settled. It's still a problem, but we've kind of settled here a bit. The Macquarie kind of view is that commodity prices cool incrementally. So maybe that helps further. And then I guess what's been clearly surprising on the upside is just the strength of flows and liquidity, right? So foreign flows have kind of come back in August. It's a very strong number. And that's after a period of about 9 months worth of outflows. So you have foreign flows coming back, domestic liquidity in equities remains strong, right? So redemptions have kind of remained absent to some extent, or that trajectory has been lower. Inflows have been fairly solid. So you have domestic liquidity, which is ample, foreign flows kind of coming back. Some of the key risks which you're speaking about 9 months back, that being more reflected in the base, right? So to that extent, Neeraj, I think the way we're feeling is that we're feeling more comfortable, if I may, if that's even possible in this kind of current global backdrop. But we're feeling a bit more comfortable with some of these valuation premiums compared to what we were a few quarters back.
Okay, a couple of follow-ups here, but before that, what would you? There's this one point that you make in one of your notes, that the richness in valuation could also be explained by the diversity in market mix compared to what it used to be earlier. Can you elaborate a bit on that? Have I misunderstood what you were trying to say?
No, I think it's just about kind of it kind of ties back to growth, right? And growth expectations, and whether it be kind of financials, IT, consumer, all those things. I think the bigger piece there was just about kind of, when you think about, you put all those pieces together and kind of aggregate this up. What we're looking at is today about 70% on a 2-year forward CAGR earnings growth perspective, right? You compare that with emerging markets versus the world, it's still speaking that kind of potentially superior growth outlook. I think it's more speaking about that, Neeraj, kind of being a driver of the valuation premium, if I may. And within this, I think, like one of the points we're trying to make is that, when you look at financials, we feel that a lot of the story is already told. Optically, you are going to see a lot of growth from the financials. The strength of balance sheet is okay. We are actually speaking about a credit upcycle. and the likes. So financials where we've seen a lot of pain already in the books, incrementally things look better, right? IT similarly, okay, fine, not high growth, but we're still feeling fairly comfortable with that, say mid-teens kind of growth outlook, which is probably slightly above consensus. And we think margins kind of surprise in the upside. Consumer similarly, I think the bigger points there is on discretionary. And there, one of the points we're trying to make is that from where we are from a consumer wallet perspective, we think that the India has a good shot of increasing its discretionary wallet from say which is about 25% of the mix today towards about 40%. So the growth there is superior, right? So I think it's more speaking about that, Neeraj. And then for more of your industrial type of sectors, what we are kind of speaking about is far more confidence or visibility in terms of government capex kind of coming about, right? Um, so those kind of aspects play into that story.
Okay. Okay. Um, so, let me try and understand from you. Um, I mean, in your earnings piece, right? For example, you give fairly elaborate descriptions of where the consensus lies. Now, my question to you is, when you look at things the way they are and hypothesize about what the scenario could turn out to be end FY23, arguably FY24, if it's possible to look that far out in a volatile world as we are in right now, do you have comfort in forward valuations, or do you believe the recent uptick from those 15,300 levels kind of bakes in the positivity of that? I know. I see. I know you made this point that relative to EMs, we are multiple premium levels above standard deviations, etc. But in isolation, do Indian earnings give you comfort, or is the price movement baking in all the positives?
So thanks for the question, Dheeraj. So I think one of the themes which we've kind of found interesting is that if you actually plot consensus earnings expectations rolling 2 year forward, right? This is, let's say, the index, and I'm using MSCI here in this example. But so if you plot MSCI India kind of on an absolute basis and then rolling 2 year forward consensus earnings expectations, over the past 20 years, the R squared for that relationship is over 90%. So it's been a very, very strong correlation, right? So to that extent, the path forward from an earnings perspective clearly kind of drives where we go from an index level, right? Now, that same model, if I may, given where we are today, we are probably slightly overbought, right? And so to that extent, so I think maybe there's a bit of a pullback here, right? But in a broader sense, if the question is about, okay, are we looking at 17% 2 year forward earnings CAGR, and are we feeling comfortable today versus say 1 year back, that is more achievable? I think it is, right? So if you think about, again, just to kind of go back to the sectors, financials we're feeling comfortable, and in fact we're seeing upgrades come through, right? In IT here, despite the recessionary kind of pressures and fears, if you actually look at revenue estimates, that's fairly stable. So it's a risk in the background, but we're feeling still fairly okay with where our revenue projections are, and that's a fairly healthy growth number. Margins have been substantially cut for fiscal 23 and fiscal 24. And if you look at expectations for fiscal 24, that's below what the sector has delivered over the past, say, 10 years, in an aggregate sense. And one of the points we're making incrementally is that that we think that margins for the IT sector surprises in the upside into fiscal 24, as some of these attrition kind of pressures kind of ease, and as you have better utilization, so on and so forth, right? Similarly with consumer, right? So if you look at consumer staples, this as an example, again, margins have been substantially cut for fiscal 23 and fiscal 24 related to these commodity pressures. Incrementally, to the extent that commodity prices were to cool, which is kind of the Macquarie base case. So we're more in the camp that oil prices cool towards, let's say, $70, in the next 12, 18 months, rather than being at 150. So if you kind of subscribe to that view, then incrementally maybe, yeah, we're looking at margin upside here for staples as well. Right? We look at industrials, similar comment, where that sector has been like significant. There's been negative operating leverage to a large extent, right? And so all this kind of government capex comes out, then that you're seeing a margin expansion kind of play out there as well. Areas where we're less kind of convinced or sure about materials, energy. So those areas where Yeah, there is probably downside here to work through, but large parts of the picture, Neeraj, uh, I think the key takeaway is that incrementally we're feeling a bit more okay with these estimates, and that wasn't our position, say 12 months back.
Okay. Well, so clearly, I mean, from the first answer and this answer, there is a lot more optimism in your mind, Aditya, than what was 9 months back, which is great to know. Now, do high frequency indicators support this? Part one. And part two of my question: are the clients that you're talking to um, kind of buying into this story? Because it's difficult to kind of invest in the neighbor's house when your own house is on fire. And clearly, Europe, if not the US, are certainly sitting on a pot boiler currently.
So there is no working around the valuation dynamic, right? It is a eye-watering valuation, and the premium is steep. Um, and yeah, there is no working around that, right? Within that rich valuation backdrop, though, I think we are still kind of selective, bottom up, few ideas we like, right? Now, in terms of ties back to the question about the high frequency and where we're positioned, right? So I think the high frequency, the earnings visibility is kind of where those are some of the areas where we'd be more positioned here over the next, say, 12, 18 months, right? So maybe in terms of what's working and kind of where we are kind of clearly seeing this kind of play out and where we are positive. So let's take the entire kind of manufacturing and banking credit as an example of this, right? So just at a in terms of the high frequency data again, so what you'd see is that the credit flow has picked up, right? And credit industry has particularly kind of picked up after a fairly sharp, protracted kind of downturn, right? Where the credit growth was anemic. Now, to contextualize this, if you take the story back 10 years, loans to industry was about 40% of bank system credit, right? Today, we're slightly less than 30%. Now, within that entire piece, manufacturing was 25% 10 years back. Today, we're at 15%, right? And so, and even from a credit to GDP multiplier perspective, if you look at, say, 2000 to 2010, that multiplier was about 1.9 times. Past decade, you've been basically one, right? And incrementally, kind of the point we're trying to make is that with the positive, some of the positive we're seeing in the manufacturing sector, early days, but we're calling for that inflection or an improvement in that credit to GDP towards that 1.3, 1.4 times, right? And so to kind of work on that a little bit. So one is you are seeing real time that credit flow to industry has picked up. Partly it's working capital oriented, so I don't think it's capex in itself. But then when you look at the, like ties back to what's happening and on the real time, take the RBI manufacturing survey, right? Expectations there have been fairly optimistic from the MSMEs across India. Take the IHS PMIs, that remains expansionary. One of the indicators we actually look at is companies filing with the Ministry of Corporate Affairs. And we look at kind of the number of companies in the manufacturing sector and across subsectors and across states. There's been a fairly sharp improvement in the number of companies setting up and filing returns with the Ministry of Corporate Affairs. I think that's again a few indication of kind of future profit pools, right, and kind of confidence. So that's encouraging. Exports in itself, sure, there's been a bit of a moderation in the past few months, but if you think about in dollar terms, this is 19, you're still tracking up over 35%, right? So you kind of put all those pieces together, and then you kind of take a view that, so when you look at capex in say 2 years' time or 3 years' time, and if you look at capex intentions, several sectors, right? The new announcements or capital intentions compared to say the prior 10 years, it's incredibly strong, right? So whether it's the specialty chemicals, electronics, machinery, renewables, all these areas, quite a few areas and subsectors, you are seeing strong capex intentions compared to the prior 10 years. So you're going to put all those pieces together, and kind of I think the formalization piece is probably most important in terms of as a multiplier impact. You can kind of see how that kind of ties in with banking system credit and that kind of improving, right? And that's structurally improving. And so the way we're kind of looking at that is to then say that, so you look at the state of earnings, a relative sense, look at the state of the bank balance sheets, look at the provision coverage ratio, all those aspects. We're feeling comfortable there, right? I think that's one example, Neeraj, of kind of the real time, the earnings expectations, where we're feeling comfortable with valuations and where we'd still be positioned here today. I would admit that I think financials is a bit of a consensus kind of long position here right now. But that's an area we are feeling comfortable. Right? An area which probably we're above consensus is on the IT sector. That sector has not done well, but similar to the points is making some time back, we're more optimistic on the margin trajectory there, and that being a trigger into 2024. So just give me a flavor of kind of where we'd be positioned. It remains fairly selective and bottom up. I don't think that the top down call given valuation is to say en masse call for a slam dunk buy in India. I think that's not the case. That's not our position. But bottom up, I think we find opportunities.
But are your clients buying into these arguments? We've seen some return of the FI community. You expect more?
I think just to your point, right? So despite the valuation premiums, we've seen in August $7 billion worth of inflow, right? And I think that alone kind of speaks volumes, right? That you've been through a period of kind of turbulence, into July and into August, you're seeing foreigners kind of come in. Now, whether that is a lack of alternatives or whether that is kind of fundamentally buying into the kind of structural kind of growth narrative, that's hard to distinguish, quite frankly. But no, I mean, so despite the valuations, I think the fact that foreigners are kind of investing here in India is encouraging.
Yeah, Tinati. There's no alternative to India. Anyways, my final question, Aditya, really would be: how do you see the decade? So, like 2011 to 2020, if you will, arguably from India's perspective at least, was a decade wherein B2C companies of all kinds literally thrived. The large argument that a few people are making is that you will see a return of B2B. Now, embedded in your answers, wherein you speak about manufacturing, etc., it seems to be that B2B is certainly picking up. My question to you is: do you think it's a sustainable theme? Could this be a decade of the return of the B2B companies as opposed to it being concentrated only in the B2C space?
I think it's a phenomenal kind of observation, right? So I think, Neeraj, so we're more in the camp that I think it's more that B2B decade, if I had to pick between the two, if I may, right? And you have kind of, at least within looking at multiples as an example, you've seen a fairly sharp re-rating in some of these consumer sector companies. So with consumer, it's, look, so as I mentioned about discretionary, today discretionary spends is about 25% of the overall consumer wallet here for India, right? And one of the themes we speak about is where we are from a GDP per capita perspective and savings perspective. Just the math in itself for this is going to mean that it's going to be a fairly sharp theoretical inflection towards discretionary spending, right? So one of the themes we speak about is that 25% kind of wallet going towards about 40%, discretionary spends rising at say 15% CAGR over the next decade, right? So despite, and then on top of that, we got for the listed space where we're overlaying some element of market share gains, so on and so forth. But to your point, Neeraj, I think like where valuations are at, large part of that growth seems to be priced in several areas. Now we still find opportunities in certain stocks, but it's very selective, you know, depending on kind of where we are in terms of what growth is being priced in. So in terms of the opportunity, I think which we are thinking about, it is that B2B space which you had kind of mentioned, whether that be kind of B2B from an IT perspective or whether it be B2B from a manufacturing and exports perspective, or kind of the financial channel kind of funding credit to manufacturing. That's broadly how we're thinking about this, right? And yeah, I mean, so times back again to the big picture. We still are amazed by the fact that merchandise exports, the share of merchandise exports to GDP for India is only about 11%, right? It's still small in a emerging markets context. The proportion of manufacturing to gross value add GDP is still low, right? It's been the hope trade for the past, say, 5 decades, if I may, right? But I think the key piece is that you are seeing signs of optimism, right? And kind of circle back to what I was saying about formalization trends, new business being set up across sectors, across states. And there's been a fairly sharp improvement that in the past 2 years. Partly this is all GST driven. I think we should also kind of acknowledge that there's been the cut to the manufacturing tax rate. There's a broader kind of supply chain diversification kind of story in the background. It's hard to distinguish these factors individually, but There is
Yeah.
momentum there. So all that kind of keeps us a bit optimistic. And then even the new intentions for some of these selective sectors compared to the prior 10 years, it's fairly sharp, right? So all that keeps us a bit optimistic. I would still say that that capex growth phase is to be proven, but the signs are there.
Got it. Well, let's make do with the signs currently, and hopefully, for India's good, that turns out, comes in really faster than what everybody anticipates right now. But lovely talking to you. The point about the differential in the view on IT and margin theory, the point about the consensus, and this whole last observation and the high frequency indicators. Lots to ponder over, Aditya. Thank you so much for all of that.
Thanks, Suresh. Thank you.
The pleasure was ours, viewers. Thanks for tuning into this leg of the Talking Point.